Hello and welcome to the 14th edition of the GreenWave podcast by SYNI International. I'm SYNI, your host, and today's topic is the current state of banking and financial commitment to a sustainable future. Pour yourself a cup of something comforting, coffee, tea, maybe matcha if you're feeling particularly on trend, and let's settle into a deep dive on the evolving relationship between big finance and the sustainability movement. Think of me as your friend down at the cafe who's nerdy enough to have followed all the debates on net zero pledges and ESG regulations, but still can't resist cracking a cheeky comment or two along the way. This conversation arises in part because of some disconcerting news making the rounds. Over recent months, large institutional investors and major global banks have been peeling away from the sustainability-focused alliances and organizations they once trumpeted. One widely covered example is a major asset manager dropping references to sustainability or ESG in numerous funds, thanks to new European regulations about fund naming. Another sign is the string of big banks that left the Net Zero Banking Alliance. That alliance was originally designed to bring financial institutions together to coordinate their paths toward net zero emissions by 2050. So, why are they backing out now? Is it all just political drama, or do these departures herald a bigger retreat by finance from the sustainability agenda? In a few minutes, we'll talk about what specifically happened, which bank left, which sustainable institution, which asset manager scaled back or rebranded its ESG pledges, and what those changes might mean for enterprises that want finance for clean energy or sustainable projects. Then we'll look at the backstory of the Net Zero Banking Alliance, how it was created, when, and by whom. We'll do the same for some of the main associations in the asset management world that aim to integrate ESG. We'll also weigh whether banking and asset management can move beyond the swirling political climate of the day and stick to their net zero knitting, even if that knitting now has some dropped stitches. Finally, we'll explore what might happen to sustainable financing as global governments ramp up defence spending, and how bread and butter banking activities like underwriting green bonds and lending to sustainable initiatives could evolve going forward. So let's start with the big question everyone's asking. Do these high-profile exits mean the era of robust bank support for sustainable development is over? A quick spoiler. Probably not. Though it's easy to get alarmed when you see big names stepping back from net zero groups, the real story is more nuanced. We're in a phase where the word ESG has taken on a political charge, especially in certain regions. Financial institutions that once used the ESG label almost as a badge are now either rebranding or quietly continuing the same practices behind less controversial terminology. They might still invest in wind farms and solar expansions, but they don't want to plaster the acronym ESG on every prospectus. That's especially true in North America, where some politicians have criticised or even legally challenged banks and asset managers for allegedly discriminating against certain sectors, namely fossil fuels, under the banner of sustainability. As a result, a number of banks are deciding that net zero alliances aren't worth the headache, at least in the short term. The Net Zero Banking Alliance itself is a good example of how these tensions have come to the fore. It was launched in April 2021 by the United Nations Environment Programme Finance Initiative, with support from the Sustainable Markets Initiative. In essence, the alliance brought banks together around a pledge to hit net zero financed emissions by 2050. This is important because banks can have a massive footprint, not just in their own offices and data centres, but in all the projects and companies they fund. If you want to limit global warming to well under 2 degrees Celsius, you need those trillions of dollars in the banking system to be aligned with the Paris Agreement. The alliance took off quickly. Within months, dozens of big banks, especially those with headquarters in Europe, signed on and began discussing how to measure and reduce emissions across entire loan portfolios. That's a big job. It meant talking to corporate clients, setting sector-by-sector targets, disclosing progress, and sometimes refusing financing to projects with high carbon intensity if there was no plan to transition. In Europe, that was largely accepted and even encouraged by regulators and the general public. In North America, though, this started to become a political lightning rod. Before long, some states in the US accused banks in net zero alliances of forming a climate cartel. Banks were threatened with losing business in states where fossil fuel companies play a huge role in the economy, or being sued under antitrust statutes, or singled out by elected officials who saw net zero commitments as a veiled form of activism. Meanwhile, a shift in administration policy signalled that the next US government would be far less supportive of climate-focused alliances. By the end of 2024, you had several large American banks leaving the Net Zero Banking Alliance, quickly followed by others in Canada and a few in Asia. This exodus caused a stir because it looked like a retreat from climate commitments. The banks typically insisted they were still serious about managing climate risk, but that they wanted to do it on their own terms, without being in the crosshairs of political scrutiny. We saw something similar among asset managers, notably one of the largest in the world, which withdrew from a net zero pledging organisation and then started removing ESG-related language from dozens of its funds. But let's be fair, as new rules from the European Securities and Markets Authority kicked in, there were actually more requirements for funds using the label sustainable, ESG, or impact. It's no longer acceptable in the EU to slap an ESG sticker on a fund if only a small percentage of that fund's assets actually meet sustainability criteria. On top of that, you have a wave of anti-ESG backlash in the United States. So, from a global perspective, big asset managers are thinking, maybe we drop the explicit ESG tag altogether. That way, we aren't at risk in states that consider ESG an unwelcome intrusion, and we stay compliant in the EU by only using that label where we're sure we meet the new standards. In effect, you see a rebranding wave. It doesn't necessarily mean these asset managers have stopped supporting sustainable projects. They might just have toned down the marketing. Some critics call it green hushing, where firms continue to integrate climate factors into their decisions, but do it quietly to avoid controversy. Now, let's talk about the implications for enterprises that need bank finance for big, capital-intensive projects like renewable energy. It's natural to worry that if banks are stepping away from net zero alliances, they might also be stepping away from financing all those solar farms, onshore wind arrays, or battery storage innovations we rely on to reduce carbon emissions. However, the economics of clean energy remain robust. Renewables have become cost competitive, and many banks want a piece of that market. Consumer demand is also pushing for green solutions, and ironically, a lot of the political fuss is overshadowed by practical business logic. Lending to large wind or solar developments can be lucrative and less risky over the long term than continuing to finance new coal-fired power plants. Indeed, you'll still see major banks underwriting green bonds or setting aside capital for sustainable infrastructure. The difference is that some might do so more discreetly. That said, we can't ignore the swirl of politics. Where some governments are ramping up rhetorical attacks on woke investing, others, particularly in Europe, are steadily tightening the rules around what counts as sustainable finance. Europe's approach is fairly strict, with a classification system for sustainable activities and a requirement that funds labelled as green or ESG really invest in line with those promises. The push by the European Securities and Markets Authority to ban or strictly limit the use of terms like sustainable in a fund name if the fund doesn't meet clear thresholds is a good example. So, big asset managers might rename certain products. Instead of an ESG clean energy fund, you just call it clean energy fund. or drop references to sustainability altogether. In many cases, the underlying holdings don't change. So the net effect is that the product is still out there investing in low-carbon assets, but it's no longer wearing a big neon sign that says ESG. Over in North America, there's a more fractured landscape. The federal government may attempt to push for climate disclosures or new rules, but states or political forces can push back just as strongly. That can make some institutions cagey about publicly committing to net zero strategies. It's not that all these banks have become climate deniers. Some are simply trying to dodge a wave of negative publicity or threats of litigation. On the flip side, some regions like New York or California remain supportive of integrating climate risk into finance. So, a large institution that operates nationally might end up with different messages or products depending on where it's marketing. That can create confusion, but it also means that the idea of shifting capital flows toward lower carbon industries hasn't disappeared. It just looks a bit scattered at the moment. Now, let's take a quick historical detour. The Net Zero Banking Alliance was launched in 2021 under the bigger Glasgow Financial Alliance for Net Zero. You had big names across banking, insurance, asset management, and other financial sectors stepping up to say, we need to align our portfolios with the Paris Agreement. Similar alliances were created for asset owners, pension funds and insurers, asset managers, and so on. Over time, these alliances grew to include hundreds of members managing tens of trillions in assets. It was arguably the biggest statement from the finance world that they recognized climate change as a systemic risk they had a duty to manage. Now, a few short years later, we're seeing a wave of leavers. There's real tension about whether these groups remain voluntary clubs with big PR value, or if they evolve into stricter associations demanding real decarbonisation. If the alliances attempt to impose real accountability or binding rules, some banks are more likely to flee. If the alliances remain too flexible, critics argue they're toothless. It's a balancing act between ambition and practicality, especially under a political microscope. We should also check the other big question. What about the future of sustainable financing when governments are diverting more resources to defence or other priorities? The truth is that the world's new focus on security and defence can overshadow climate funding. If a government's budget is being pulled in multiple directions, strengthening the military, tackling inflation, dealing with social programmes, sometimes the large-scale investments needed for clean energy can feel squeezed. Yet, it's not a total zero-sum game. In certain parts of the world, the pivot away from dependence on unpredictable suppliers of oil and gas has actually encouraged more investment in renewables as a matter of energy security. Some banks see big opportunities to finance that expansion, especially in Europe, where the combination of new defence commitments and a desire to reduce reliance on imported fossil fuels has led to bigger and faster renewable build-outs. So the big question is how these parallel processes, defence build-up and the green transition, interact. It might be more complicated than just one overshadowing the other. Returning to the world of underwriting green bonds and providing loans to corporate sustainability programs, many bankers still see this as a profitable path. Green bond issuance has grown rapidly as more and more companies look for capital specifically labelled for environmental projects. Those deals generate fees for banks, help polish a bank's green credentials, or at least help them claim a role in financing low-carbon solutions, and can be packaged in ways that appeal to institutional investors with sustainability mandates. Even if you see fewer banks publicly broadcasting net zero membership, they're still going to chase these deals because the market demand remains strong. The same applies to sustainability-linked loans, which tie the interest rate to meeting certain climate or social performance targets. That can be a win-win. the borrower gets better loan terms if it meets carbon reduction goals, and the bank can point to a more future-proof approach to risk. Now, let's zoom in on whether these developments, like banks quitting net zero alliances, should alarm any business or organisation looking for climate-friendly capital. If you're hoping to fund a new solar farm or an innovative energy storage facility, is it going to be harder to find supportive financiers? So far, the evidence doesn't suggest a dramatic retreat from financing viable green projects. Banks might not want to be locked into an alliance that sets rigid decarbonisation targets for their entire balance sheet, but that doesn't mean they dislike investing in low-carbon energy if the numbers pencil out. In many cases, you'll find it's still relatively straightforward to get support from big banks if your project is bankable and if you can show a strong business case. In other words, the money remains on the table, but the bankers might not use the words ESG synergy quite as loudly as before. Of course, there is a real possibility that the climate finance momentum could slow if political pressure intensifies. If certain regions aggressively punish banks that appear to discriminate against high-carbon companies, that could tilt the playing field back toward fossil projects. Then again, many large banks are global and can't ignore the climate regulations or carbon taxes that are increasingly being implemented in other regions, so they can't simply disregard climate risk. If the science and the economics say a coal plant is going to be stranded in 10 years, banks will weigh that accordingly, net zero alliance or not. Pragmatic self-interest can sometimes accomplish what altruistic pledges cannot. Meanwhile, the push for accountability on the regulator's side isn't going away, especially in Europe. We can expect more intense scrutiny of fund naming, marketing materials, and actual portfolio holdings to ensure that if a fund says it's green, it really is. That's partly what's behind major asset managers removing or replacing the word ESG from so many fund names. They're preempting claims of greenwashing. If you do want to maintain that label, you must comply with various criteria for what counts as a truly sustainable asset. That might raise the bar for fund managers, but it also reduces confusion for investors. With some consistency in definitions, it becomes harder for a manager to say, "We're a green fund," while holding a big stake in questionable ventures. In that sense, these new regulations might actually strengthen the quality of sustainable finance offerings over time. We might end up with fewer but more credible, green or sustainable funds. Another crucial point, net zero alliances came with the idea that members would set intermediate targets, usually for 2030. That gave the alliances some teeth, but it also created a potential vulnerability if members turned out to be behind schedule, or if those intermediate goals demanded swift cuts to fossil fuel financing in certain sectors. Exiting the alliance frees a bank or asset manager from having to justify each annual step toward the target. It might also spare them from the scrutiny of environmental advocacy groups that keep track of who's truly decarbonising and who's just talking a good game. So yes, from an accountability standpoint, losing members can weaken the alliances, but those departures may not necessarily stop the same institutions from writing checks for renewable energy projects. They might simply do it in a more ad hoc way. With all this in mind, it's safe to say that enterprises needing bank finance for sustainable energy projects shouldn't despair. The broader shift to decarbonise the global economy continues, buoyed by many drivers: policy, consumer preferences, investor demands, corporate commitments, and technological advancements. Even if the top-level alliances lose some members, that doesn't erase the fundamentals behind green finance. That said, expect more caution and more subtlety in how financial institutions talk about climate commitments, especially in politically polarised environments. The tension between the defence sector and sustainable initiatives is another factor in the bigger picture. Many governments are spending more on defence. That can mean less government funding for climate initiatives if budgets are constrained. But there's also a countervailing dynamic. The drive for energy security can incentivize renewables, especially in countries concerned about reliance on unstable regions for fossil fuels. So there's a possibility that defence-minded governments might also ramp up production of domestic clean energy in parallel, which could create more impetus for banks to fund such projects. The calculus is complex, but a scenario where defence budgets overshadow everything else is not guaranteed. Markets for green bonds and climate-themed financial products are strong and often driven by private capital or a mix of public-private funding. At the bank level, underwriting green bonds remains an attractive line of business. Investors are hungry for assets that meet green criteria, whether or not they carry the official ESG banner. Banks know that a well-structured green bond from a reliable issuer often sells quickly, sometimes at a premium. Underwriting volume for green and sustainable bonds has been robust for years. That trajectory is not likely to be reversed by some high-profile net zero alliance exits. The same applies for sustainability-linked loans, or corporate loans earmarked for climate-friendly capital spending. So, while negative headlines can certainly rattle the nerves of some who hoped for faster decarbonisation, the day-to-day reality on trading floors and in corporate lending departments is that green transactions can be good business. Now, let's fast forward a bit and imagine where we might be in 2 or 3 years. If the political environment remains polarised, we might see more rebranding, more name changes, and more banks stepping out of public pledges. They'll say, "We're doing climate risk management on our own terms," hoping to avoid the drama. Some net zero alliances might shrink or refine their membership requirements to weed out banks that signed on only for optics. But in parallel, the unstoppable logic of technology and risk management will likely keep pushing capital toward cleaner industries. And in parts of the world, particularly in Europe, you might see a new generation of climate-focused regulations that quietly raise the bar for everybody, no matter their membership in voluntary clubs. Over the longer horizon, it's plausible that net zero commitments could be baked into actual law, which would overshadow any question of alliances. So, while it's understandable to view these developments with worry, I'd encourage anyone interested in the evolution of sustainable finance to adopt a slightly more nuanced viewpoint. What we're seeing may be part of the normal process by which radical ideas first gain steam, then meet resistance, then get integrated in more ordinary ways into the system. That's not to dismiss the frustrations of advocacy groups who want faster progress, nor to deny the real possibility that backsliding could occur. But watch the numbers. If bankers continue to see a profitable long-term future in financing green ventures, and regulators worldwide keep rolling out policies to support them, the money will keep flowing. It might just be labelled differently, or come from banks no longer waiving net zero membership papers. We're at a crossroads moment. Financiers of all stripes are evaluating whether to push full speed ahead on net zero targets, or to step back and let politics calm down. Yet, the climate risk itself isn't going anywhere, and ignoring that risk is generally bad business. So it's likely that behind closed doors, many institutions are continuing to do the math on how to reduce exposure to high carbon assets and invest more in sustainable technology. They'll do it with or without the alliances, because that's what the emerging market environment demands. We'll keep an eye on how these alliances evolve. Some of them might come back stronger once they clarify their membership obligations or secure safer legal ground. Others might fade into irrelevance if too many members depart. What matters most is the real-world flow of capital into cleaner solutions: wind, solar, hydrogen, battery storage, more efficient manufacturing, sustainable agriculture, and all the rest. That's the big story, and so far it's far from over. At this stage, you might be thinking, so what's the final verdict? Are we looking at a fleeting wave of retrenchment, or is it something more permanent? My guess is that it's a rebalancing. There will be less hype and more substance. Some financial institutions will keep working on climate alignment, but they'll be quieter about it. Others might scuttle back to old ways if short-term profits in fossil fuels beckon, especially in a political climate that rewards that. The key factor is whether the broader economy continues to pivot decisively toward low-carbon solutions, driven by consumer demand, economics, and regulation. If that pivot maintains momentum, finance will adapt no matter what alliances do. It's capitalism's nature to chase opportunity and manage risk. Right now, the world's greatest challenge, climate change, also presents enormous opportunities for innovative financing and project development. Banks know that. They just might not trumpet it under the banner of net zero alliances, at least for the time being. Well, that's a wrap on our 14th GreenWave podcast episode. I appreciate you sharing your time with us today. You can find us on Apple Podcasts, Spotify, iHeart, Podchaser, Boomplay, and Player FM. So feel free to follow and share with friends. You can give us a nice review if you're feeling inspired or generous. If you missed any of our LinkedIn posts or the GreenWave Gazette this week, no worries. You can always catch us on LinkedIn, X, Facebook, Instagram, or visit synergy-international.net. We'll keep reflecting on the trends shaping sustainable finance and global policy. Until next time, keep riding the green wave of sustainability. Stay inspired and keep advocating for a healthier planet, one sustainable investment at a time.